So I'm Cyril Hoyaux. I'm co-heading this debt fund platform, which is a partnership between two sister companies within the Natixis Investment Management Group. So I have my co-head with me, Arno Eck, who is on the Ostrom or ex-Natixis Asset Management side. We started this debt fund initiative about 6 years ago with a first fund, a senior debt fund, Self One, which is now fully deployed since 2015. We raised 320 million euros. We are now working on Self Two, for which we expect to raise above 600 million euros. We have now more than 500 million, which are now, let's say, 70% deployed. And we want to also launch Self-Free by the end of this year, but other strategy, and to be less focused on senior debt and try to also be involved in let's say more value-add kind of debt strategies, such as stretch senior, junior, and even mezzanine for a small part of it. That's our objective for Arno and I for the coming months.
Okay, great. Alexander.
Good afternoon, Alexander Fischbaum, AF Advisory. A little bit about myself. I am in the UK for 20 years, structured funds for ING, then went on to become head of real estate mezzanine at Barclays Bank, went into Barclays Capital, and then changed back to the investor side, working at Orion Capital Managers as an investor. And in this time I realized that there is a bit of a disconnect what the investor says and what the credit officer understands. And so that leads to rejections of good deals that should be put through, or mispricing of deals. And I said this is very inefficient. And when I stuck out 4.5 years on my own, I said we're going to write the credit paper as it should be written, 30, 40, 50, 60 pages with all the information the credit officer needs on behalf of the borrower, and send it only to a small numbers of the right banks, because as you see there are always more and more banks, and it's no good sending the wrong thing to the wrong bank. So our service is an advisory service. We cradle to grave, we negotiate the loan agreements, term sheets, everything till drawdown. And the key thing is that we work only on the borrower side, so we never have a conflict of interest, and that makes it cheaper because we get the best terms for the clients by selecting the right banks. It makes it faster because we do the work up front, and it makes it more reliable because we know when we send our 30, 40, 50 page paper that the bank knows the upside as well as the downside and can make an informed decision. And that's actually in a competitive environment what you want. What have we done last year? We've just closed a 150 million deal in Germany on the 20th of December. We've done a wonderful deal with Assem and his colleagues, which was great working together. We've raised equity for hotel development in Spain because we do senior to mezzanine, pref equity and equity. Our clients were outbid all the time in the UK last year, so that didn't work well for us, but we see pricing improving, so we are active in the UK again. And we're looking into the Netherlands, where we've historically done deals, but the pricing there is also very high, and we are obviously accompanying our clients rather than doing the deals ourselves.
I'm Assem El Alami. I represent Berlin Hip. Berlin Hip is a typical German balance sheet lender up to now. We shall see maybe in the course of discussion if that will remain that way. We have a balance sheet of 30 billion, 560 staff of 560 is our head count. Where we are present in the Benelux with a team in Amsterdam, we're present in France with a team in Paris, and we are also present in Poland with a team in Warsaw, which will also cover the Czech Republic. So that's our geography, not very big, but which led to north of 8 billion of new loans last year, of which approximately 6.7 billion were new loans, the rest were extensions. And we had a build-up in our balance sheet by approximately 2.5 billion. Why am I describing that? Because, of course, for a bank like ours, it's probably very delicate to have that level of production and never think about distributing, and that's where this panel makes all that sense. And that's makes us very anxious curious to see what Cyril has to say about the future with cooperation with the banks.
My name is Christoph Wagner. I work at TH Real Estate. On the debt side, TH Real Estate is a completely real estate focused asset management business with about $100 billion in assets under management. 25 billion of that is in commercial real estate debt. We've built the platform out of London up to about £2 billion over the last 3 years. Out of two main strategies. One is a senior lending mandate, which is a longer dated proposition for our borrowers, and the other part of the platform is a debt fund, which is more flexible in terms of providing shorter term finance and also being able to underwrite business plans and more transitional assets. So that's what we do.
Okay, good. It would be good just to pick up some of the sort of more general market themes in terms of, we've been doing a lot on political risk, politics. You've got growth in GDP growth coming through in Europe, especially strong in CE. What's your sense, maybe just starting with you, Alexander, in terms of the politics or economics, what do you think is going to be the sort of main driver, let's say over the next 12 months, if we look back next year at MIPIM? What's your view on that?
Okay, I must say we focus only on 5 countries. We're a small team of 5 people, so we can't do every country. Germany, UK, Netherlands and Spain. And then we have a bit of France exposure. Let's go through these countries overall. Germany has now finally a government which made the Italians happy. Everything continues as normal. I think the key question hanging over that is who will be the new ECB president. If it's Jens Weidmann, I think we will see a more hawkish stance on interest rate, and that will filter into every country. If it is a good fudge, as the European Commission loves it, it's going to be not changed. So Germany is still a strong destination, huge margin pressure on banks, but the underwriting gets much more selective. So I would say the box is still full of money, but it got narrower. You have to be really in the right spot and prepare it well. UK is a repricing of assets going on in residential as well as commercial, and that is I think positive news for investors. UK banks are in different stages, some more aggressive, some less, but I think the pricing will remain where it is, very stable. And Spain is actually surprising on the upside. Other than if you're in Catalonia, there's still activity going on, but I think that some of the investors are thinking about what they're going to do. But pricing wise, Spain very stable. Banks getting a little bit more adventurous than they used to be, but they're still humbled or caught up by their balance sheets. And Netherlands is a small market. Lovely people, I used to work there, but it's a very small market, and now lots of banks are piling in from overseas, which increase the liquidity and depresses the margin. So it's a very much a borrower's market, whereas 5-6 years ago it was a complete lender's market.
Okay, good. And anybody can pick any of these up, really. But in terms of the financing side, let's say, market risk has always been a key topic. We've had Brexit, but then you've also got Catalonia. That's interesting to point that out. But also just the change in sort of 12-18 months on a market like Turkey, which maybe people weren't investing in, but even so you can see the potential change that there is. How much of these, maybe starting with you, Cyril, is there kind of nervousness in the lending markets in terms of financing deals for some of these political risks, whether that's the change in ECB, whether or not that's money being taken out of the system? What's your thought on the possible risk scenarios?
There's no particular nervousness on the political side. We are mostly concerned by regulation. It's the fact that in Italy, for example, where we have some exposure and where we could have some appetite for lending in Italy, we still are afraid of the non-friendly lender, let's say, regulation of the lending market in Italy. So this is why we will not continue to work in Italy, because we believe that we have enough exposure, even if this political situation in Italy is not good, but it's always the case. So we are able to live with that, and we know that there is a clear separation between economic and politics in Italy. But the fact that the lending universe in Italy, with the banking system being in bad situation, make it for us difficult to continue to work in Italy. We have a focus in Spain, but the problem that we have in Spain is more due to the fact that if we want to enter into a financing facility afterwards with syndication, it's a heavy cost in terms of registration of the mortgage. So that's why we have to be at a very early stage of the process. In Germany, it's another problem. It's a problem of German bank lending at very cheap, very low margin. Probably where we could have some political issue is in Poland. Poland maybe this is where we believe that there is a clear connection between the economic situation and the political situation. Everywhere else in Europe, well, we don't suffer a lot from the political situation, even in Italy or even in Germany, where during a couple of months the situation, politically speaking, were not that clear. And I have to say a last word on the UK market, where for Self 1 we deployed more than 35% of total commitment in the UK. We did nothing for Self 2. We have doubled the capacity between Self 1 and Self 2, and we made no deals in the UK due to the fact that we have to live with uncertainty in terms of currency situation, and the cost of hedging for euro-denominated funds such as ours, it's too heavy, it's too high.
Okay, that's interesting. Assem, you wanted to pick up on the point on Poland,
I think the political risk, that's something for our business and markets is relatively neutral. We've done some thorough research on Poland, because we have quite a significant exposure in Poland, and in the portfolio of the jurisdictions where we're active, and that's probably the only one with a certain political risk. So we looked at this, and we compared it also to other countries such as Turkey, as Hungary, and we've quite clearly see that the markets don't care if there's a non-democrat in the government. They don't care if Erdogan is putting journalists into the jail. They do care about uncertainty. So the only thing that we are worried about in terms of market risk, and I have to leave the political side away, and also the aspect of political growth, of economic growth away, because that can be influenced. You're perfectly right. But when it comes to the markets, they will probably react very resilient to political risk, as long as it's foreseeable, as long as there is stability. In Poland, we've seen it very clearly. The market has reacted the moment that the government has touched the tax rulings. Yeah? That's when some commotion came up and people got worried. Yeah? So as long as a government like that don't touch the legal framework, everything goes well. Now, when it comes to the other, because I understand political surrounding also included in your question, the economic surrounding, but I think that's something we see on the long end of the interest rates, that the expectation is that we will have growth on the longer term, and with that it means that the long-term interest rates will rise, and we shall see if that will have an effect, because that is far from evident on the real estate markets.
Okay, good. Christoph, why don't you pick up that point as well? How do you as a house see the interest rates. Are you building in a view that they will normalise at some point in the near future, or do you see that as 3 to 5 years, or do you see no normalisation? What's the sort of house view on it?
I wish I had that crystal ball to forecast rates accurately.
Yeah,
but,
I was about to take notes.
But before I come to that, maybe I would add just a little bit of context around this discussion on uncertainty, whether it's Brexit or other political risks. What we're doing on behalf of our investors is we're investing in a defensive part of the capital structure. And clearly, if you're buying buildings outright, you're relying on some form of value add, some form of management potential, appreciation of the assets. That's the reason why you're typically going into certainly the less mature markets. And by lending, depending on your loan to value, you build in some cushion to safeguard against those risks just by way of where you are in the structure. So we like that aspect of investing in debt in this current market environment. In terms of rates, I think most commentators have been expecting rates to go one way for the last 3 to 5 years maybe, and what we've actually seen is rates going sideways and a bit of a hike in the scheme of things, which feels like a lot, about 50 basis points over the last 6 months or so, and it feels like a lot because we've been in such a low rate environment for a really long time. But in the grand scheme of things, actually, it's not such a massive change that we've experienced.
What is a long time?
Yeah, and clearly a lot would be if it's enough to really change investors' perceptions about appropriate property yields, and that's where it would really start to impact us as lenders. So anything that's a sudden and marked jump in rates would impact us. I would think a measured and slow normalization over time shouldn't be a problem on the lending side necessarily.
Okay, good. You mentioned Italy. We had that mentioned, and we were in Milan recently doing an outlook session there, and there was a view that a lot of the, partly because of regulatory things from the ECB, but a lot of the non-performing loans linked to real estate in the Italian market would need to come out over the next sort of 3 years. Do you think there's a change in terms of the Italian market, and do you think that this will begin to normalise things in Italy or not? What's your sense of that? Anybody can pick that up, but Alex, if you want to pick that up.
I didn't say much about Italy. I think you are.
Well, in Italy we do very normal things, so we are not interested by NPL, distressed loans. So when we intervene in Italy, it's for acquisition loan with big equity players such as Blackstone or every other kind of large global players. So it is not our role as a senior lender to intervene in distressed situations. So difficult to say whether it's normalizing or not. It will probably come from the normalization on the banking side, which is far from being finalized. So I think over the next 2 or 3 years in Italy, probably the difficulty will remain.
Okay, good. And are we seeing, Alexander, are we seeing more people using debt now, whether it's from traditional bank lending, whether it's from alternative lenders, or are we, because obviously at previous points in the cycle we've had people using more equity. What's the situation at the moment, do you think?
I think it's twofold. We see both. We see more demand for real estate from the investor side, because many capital sources cannot get the returns, insurances or whatever else that they need in bonds. They have 0 to negative returns on the medium or short term. Equities look fully valued, so the allocators are a little bit nervous. So investors are piling into real estate, and we have the prices coming up. And at the same point in time, companies like Natixis, Natixis has been doing it for a long time, but AEW and TH Real Estate have built a debt team, because this is another way to gain exposure on a less risky basis, as Christoph explained, and as you also said. We're getting an income. We're taking the income element without having the capital risk attached to it if we are a lender to real estate. And that is attractive. But both are actually sourced from the same pool of money that doesn't find its home in bonds and that doesn't find its home in the stock markets. So that's why I was so concerned about a change of the stance in the ECB, which would follow inevitably the Fed and the Bank of England. If bonds were to become more attractive, there would be a retraction of capital that's allocated as real estate equity. I buy a building, as well as the number of lenders, because then big allocators like Natixis would say, we get very good or better returns now in highly liquid bonds. There is a risk premium to be paid for being exposed to a real estate loan. Assem is perfectly set up to do this, but many investors will say in that case, we reduce our exposure to the asset itself and to the lender, and that can make a shift in the market. Subtle, yes, I don't expect a doomsday scenario where rates shoot up, but I think we are after the inflection point, and we are now out of an environment of ever falling interest rates. It's now the reverse, and we have to think a little bit further forward on our buying and on our financing, how we are going to look in 3-5 years if we try to turn the asset, or in 3-5 years if we're trying to refinance the asset.
Okay, interesting. And picking up that point, Christoph, are you seeing less investors wanting to invest in debt funds, or is that just still increasing at the moment? Are people looking at that and thinking, well, I'll see what happens with interest rates, I'll see what's going to happen, or in fact is just more and more capital knocking on your door?
So there are two main sources of investors who have an interest in debt funds. One is those investors who want to replace a fixed income allocation that is very low yielding in the current environment with something that's higher yielding, and investors who want to use commercial real estate debt as a different way to get exposure to the sector with the sort of capital protection and income element that Alexander explained. I continue to see strong interest from the second group of people who are saying we are somewhere through the cycle, whether it is truly latest cycle or whether we're kind of midway through. Probably depends on the market and the sector as well that you're looking at, but we're certainly not early cycle in European markets. And people look at that and say, I still like the income component, and when you look at consensus forecasts for the UK in terms of the broader sector returns, people are looking at 5% or so total returns over the next 5 years for all property, and that's a purely income-driven outcome. And you can achieve similar returns through investing in debt with the protection that offers. So that's why it continues to be attractive to investors.
Okay, good. And so in terms of the sort of volumes of debt, volumes of financing within Europe, do you expect to see that kind of continue to grow in 2018? Where do you think we are in that cycle? Do you think more investors are seeking debt and therefore the volume of debt will increase?
It's difficult to say for something for the whole of Europe, because I think there are a lot of contrasts. When it comes to maybe the core country at the moment, which is Germany, there we see lending volumes increasing, but at the same time also the capital values increasing. So is there a surproportional growth? I'm not quite sure. What I can say is probably every lender in Germany has written record results, and the next challenge will be how to keep that on the balance sheet or where to put it afterwards. So there is more debt available in the future, and we do see LTVs going up slightly, even though we try to stay disciplined on the risk side. But we do see that the competitive pressure is pushing that way.
And are you lending on things that maybe you wouldn't have lent on say 18 months ago, whether that's to do with it's an alternative sector or it's a secondary city or it's somewhere like Budapest perhaps that previously everybody had said no, we're not going to go to Budapest.
Well, we're not in Budapest, but when I take your question without a geography, we kept upfront a very coherent risk policy. However, we have to also acknowledge self-critically that values had gone up, so the 70% today is certainly not the same 70% we're talking about 5 or 6 years ago. And so in that way, yes, the risk positions have gone up. Do we finance today new assets? Well, it's always a question, do we understand the asset? If we haven't understood, for example, data centers 5 years ago, we will definitely not understand them today. So that's an asset type we will not finance. But for example, the hotel sector, where we have been very reluctant, very timid, is appealing to us as an asset class which is can be quite attractive.
Okay, that's interesting because that's the second person who's thinking about going into hotels who hasn't previously been in that in terms of financing. So that is an interesting thing to see.
I think generally you see that many lenders, I wouldn't say get more adventurous, but because the competition in the core sectors, especially in Germany, is so brutal, they have to look somewhere else, where other lenders, be it in hotels, say we don't do them on principle. That reduces then a little bit of the competition and it gives you a little bit more margin. And so lenders skill up and learn and try to become more comfortable with what is not a leased hotel but a management agreement. And that's extra margin. We live in a world that is starved of yield. You see people buying junk bonds at yields we've never seen before, subordinated corporate debt, second lien structures without security, all this stuff just to get this little bit more in return. Is it risk adjusted correct? I don't know, but as long as the economy keeps humming, many of these lenders have hope that they can refinance or will be refinanced before anything goes wrong. Lenders are in a very difficult situation because yields are terribly low for their product.
And in terms of the alternative lending sector, Cyril, are there places that you would or wouldn't go, whether that's because there's either not enough margin for you or you just simply think it's too risky?
We spoke about Italy before, where we will probably not go further. Well, we keep focusing on Western Europe mainly. We are not very interested by Eastern Europe due to the fact that it's small markets. So we try to have better work in deep market and better work where we have an office and a representation on which we can leverage to look at the building, to have a clear view on the local market, and to have information from the ground. So for us, it's probably the biggest market in Europe, such as, of course, Benelux, France, Germany. We initially wanted to open a new market for our group, which is Scandinavia, but we didn't get interesting opportunities to land. But we still have a clear appetite for Scandinavia. Maybe we missed momentum in Finland. I don't know whether it will still be interesting in the near future. Countries where we will never go is probably countries such as Bulgaria, Romania, Turkey, Hungary. That's probably where we have no appetite for those markets. Too small, too risky, no track record from the group on this particular market, or sometimes no good stories coming from the equity side of AEW.
Okay, good. And Assem, just in terms of the, you've got the banks working quite often with alternative lenders. is there really a quantifiable difference in that? So it's your chance to really say why banks are great in comparison to Cyril and Christoph, and then we can hear what Cyril and Christoph have to say.
Luckily, I know Cyril for quite some years, so I'll go ahead. And of course, banks are the better lenders in my view, because I think the main difference is we can offer a relationship which a fund and a fund manager will not be able. But does that mean that we're actually cannibalizing each other? I don't think so. I think there's a place for each of these type of lenders. And let's face it, if the banks with all the other regulatory instrument which comes up, want to do all this by themselves, they're not going to make it, because there's also some severe increases of equity ratios in the banks, of leverage ratios, which we have to work around. So, in the end of the story, debt fund like a fund from Cyril will always be a very welcomed cooperation partner at our side.
Okay, good.
If you extend loans at above 200 bips margin. On the 60%.
Yeah, we can work together if you can make your business case work properly.
And I think that is exactly the answers. It's horses for courses. You have to just find the right deal for the right lender. Assem, and please don't get upset with me, will always outprice you. Because he has cheaper money, he has the much more effective fund wave element, which is the most efficient funding element in the world. But if I need some really funky deal, then maybe, and high LTV and tough repositioning, then maybe Assem and his team, how great they all are, and we've done a deal with them, so I can only praise them, are not the right address for this. Then I go to Christoph or I go to you and I say, look, this is a transitional asset. We need money and we need very little covenants in year 1 and 2. We're willing to pay for that. And that is something that could never make it into the fund brief. The bank would have to hold it on its balance sheet, so they're not really interested in this. But for those two parties and many others, that's exactly the right asset. So coming back, we have the advantage of having so many different lenders that everybody has developed a specialty. And if you go to the right one, you can almost finance anything. But if you go with the best project to the wrong lender, you will get a no. It's very simple. And sometimes you bring those two together. For the senior part, you have someone very capable like us, and for a junior part, we have you on top. And then you can bring those together. It is really horses for courses. And
we can consider now that all the segment of the lending universe is covered by all type of lenders, whether it's bank traditional lenders or funds like us, or direct lenders such as insurance companies and such as Allianz, Aviva, etc. We used to say that development finances were not that occupied by lenders, but is it still the case now? I don't believe that. I think there is more and more lenders ready to extend loans on development, even fully speculative project, maybe less than on the core assets. The fact that the story changed between the first fund in 2012, I don't speak about AXA that entered the market more than 10 years ago, but from 2012, when we started this debt fund initiative, we have to convince banks to work with us, to send us opportunities, and we were seen as both alien and competitors. Then their mind changed, and they could see that we were long-time players, that we will be on the market for a long period of time, and then we are more on a partnership, but more on syndication, meaning that we are not involved at the very early stage of the process, and we have to work with an existing loan documentation, with the X and X covenants, and with everything already done. And maybe for the next period of time, funds like us will be more ready to be involved at the very early stage of the process, meaning that it could be seen by investors, by the sponsors, as more complexity, but we believe that our role is not to front, and we are happy if the bank keeps the relationship with the sponsor, but we want to say our view, to give our view on the structure of the debt and on the, of course, on the pricing. And the fact is that we are, as a debt fund, at the crossroad between two regulations, Solvency II and Basel III and maybe Basel IV coming very soon, meaning that Solvency II brings more money from insurance company to the lending side, to the private debt, and Basel III, IV, which is very constraining for the banks. So they have to move to the old American bank business model, originate to distribute. German banks are still balance sheet lenders, but other banks such as French banks and all the Anglo-Saxon banks finally will keep no more than 30% as a final take. So they have to take care of the exit at a very early stage of the lending process.
Okay, good. And Christoph, I wanted to pick up with you the investors that are coming into the funds. I mean, real estate in general, both for those investing in property itself, has become much more competitive. Is the same also true for investors in debt? Are you seeing new capital looking to access debt? What's the position in terms of the trends of the capital that are coming into your debt funds?
So in the UK market, the non-bank lenders have taken about 25% market share in new origination, and that's providing the additional choice for borrowers, which is a good thing. I also think it provides a lot of additional stability to the market because banks are still 10 to 15 times leveraged on their balance sheets, and any pound or euro that gets lent from an insurance company directly is £1 or euro of equity, and it's the same for Cyril's fund. £1 or euro of investment is a pound of equity, a euro of equity that goes in. So that just adds stability to the sector. And in terms of the interest from investors, we are still at a relatively early stage where, yes, people have come in over the last few years, but I don't see this being a crowded marketplace, and there is capacity, and we're not capacity constrained in terms of our investments.
Okay, and do you see investors are beginning to take a view on lower return expectations in terms of the debt funds?
That's really driven by what allocation their capital is coming out of into the sector. So some people are perfectly happy to live with senior debt returns and low risk, and they're happy with the 3% coupon. Other investors are looking at debt as an alternative to their direct property investments, and they are expecting a higher single-digit or double-digit return for that capital that they're putting in. So again, it's a range of different things and a range of expectations commensurately. And I think people are switched on to risk going with return, and that's clearly something that people are aware of, and that's guiding their expectations. Okay, good.
Does anybody have a question that they want to ask? You don't have to have one, but if you do, now is the time to ask. I just want to do a couple of just quick fire ones, which is really in terms of lending. Can you pretty much get financing for almost anything at the moment? I mean, not completely unsensible, but most development, student housing, alternative assets. Is that, Alexandra, is that available financing for most things?
I'm just thinking about whether we have come across something that was a sensible proposal that couldn't get financed, and I must say the answer is no. You can get at a price if you have the equity expertise and, most importantly, can explain to the lender the rationale and the business plan, and you have the skills to do it. You can get pretty much everything financed. It comes probably at a price. And the easier all these things, business plan, skill set, lower LTV, the cheaper it will be. But we haven't come across anything that was a sensible proposal where we couldn't find a lender, because the bonus of the diversification we have is, as Christoph said, money comes out of different capital pools. Those people who want to have a very low return, low risk, and those who have raised money in the 12% arena have to do mezzanine and have to take quite a lot of risk, and they then finance in this environment risky deals, because 12% is nowadays close or sometimes very close to the equity return on these assets. So they have to take, sometimes above, so they have to take equity-like risk. And this situation where you have promises out to your investors that you have to fulfill more or less, puts certain lenders, makes them willing to do very risky but sensible deals. So nothing stupid, but risky but sensible deals.
Assem, you wanted to pick that up?
Yeah, I think Alexander made a very good point there. I think there's there's this saying, there's no bad deal, there's just a bad pricing. Well, in the old world we had senior, and then we had maybe some junior, but it wasn't as sophisticated as it is today. And I think when we look at the world, how it will be in 5 to 10 years, then it will be even more sophisticated, because I can very well imagine an actor like ours concentrating on the relationship to our clients and then distributing the loan to whatever pocket it adequates to. Yeah? So, and one of these pockets might be the Berlin HIP balance sheet, but just one of these. We've maybe you should note that we invested into a platform called Brickless, and we are currently thinking about how to make financing work on that kind of transaction platforms.
Oh, okay, interesting. Now we're pretty much at the end of our time here, so I just wanted to ask one kind of question of all of you, really, which is, in terms of when we look back next year, what will we say were the big trends of 2018? What's your views on the big thing that you expect to see in the market this year? Let's start with you, Christoph, because you're still in the shade at the moment.
Not melting down yet. I would add a comment actually on the notion of deals are getting financing generally. I believe that we're seeing a good continuity of some discipline in the market, and that's LTVs to some degree, but that's certainly covenants and structures of loans. I would hope we can look back in a year's time and say that sort of underwriting discipline and good structuring has been maintained throughout the year.
Okay, good. Assem, you can agree with Christoph if you like, or you can have your own.
Yeah, I think I can agree to that, and we'll probably also try to figure out where the hell is the crisis coming from.
I see the whole debt market becoming more sophisticated. There will be hopefully more debt advisors like us who help both sides, but we see the banks becoming more sophisticated. That the old model where a bank did everything in every sector and just priced it as a basket, that is stopping. Everybody has their speciality. Very different banks start to cooperate, and that is a level of sophistication where they say AEW can take this slice of risk for that return, I keep this slice of risk for that return. And in our conversations with borrowers, we try to educate them, and we find them more and more receptive, that they say, hold on a second, if you want it all the way up, do you really want two financing parties with intercreditor? Do you want to have that higher level at higher price, or do you want to substitute it with equity? And the borrowers have come away from that idea that I go to one bank for everything and that must do everything for me, because the banks cannot, regulatory wise, cost of capital wise. It has become a mosaic rather than one big name that you go to for everything.
Okay, Cyril, the last word for you as our host. Yes.
For 2018, I'm not afraid with deployment. I think there is a market definitely, and considering what we have in the pipe, and we were working together with Arnaud yesterday on all the opportunities that we have in the pipe right now, and we feel very confident with the deployment of our equity. Not afraid of margin compression. We believe to be at the bottom in terms of margin. Not afraid with LTV going up. We could see a change in the borrowers' behaviors, asking for happy with 60 to 65% LTV, sometimes asking for 70% LTV, but we don't come back to the levels that we reached in 2005, 6, 7. So where as a senior lender we could go up to 80, 85%. I'm more concerned by the covenants, and I can see on some loan documentations our covenants are becoming light, and this is our main concern in some of the loan documentations that we could analyze recently. Cov light is definitely a big issue for us.